Hi, Matt McAleer, Cumberland Advisors, with John Mousseau, Director of Fixed Income. In terms of this week in equity land, kind of a grind.
Yeah, like the weather.
There's 11 sectors that are normally spoken about in terms of
Right.
the spiders or the S&P 11 sector breakdown, and 10 down, 1 up. Energy. Good bit in energy
Yes,
all week.
absolutely.
There's been a supply-demand imbalance. You've got some squeezing going on out of OPEC, and then on this side, we're getting back to that point that there were 5, 6, 7, 8 years where maybe not enough money was put in to infrastructure,
Right.
and we're lagging a little bit. So in terms of owning energy, very nice. In terms of running up to the pump, not so great.
No. And, as you look at the big picture, right, will that feed into some of the inflation numbers next week? Most likely. And certainly on the headline number. And also, the flip side of it causes people to pinch in a little bit too, right?
Yeah, there's so many pieces of the puzzle to inflation.
Right.
There's so many pieces to the puzzle to markets, when we spoke about this last week, whether it's commodity markets, whether it's equity markets, whether it's fixed income markets. Right now, those puzzles are a little juggled, but I'm still on the thought pattern that I discussed last Friday, that we are just in that grind type of market. And I wouldn't be shocked if we traded, between a 4,200 and 4,600 in the S&P for a month or so, and we'll put some money to work on those pullbacks and test it. We'll test the market on pullbacks. Mentioned last week, I still like industrials. We saw a little softening in industrials last week. We started a position, 3-4 weeks ago. We're going to add to that next week if we get a little more softness. Yeah. How about in fixed income? What's looking attractive?
Another yawn week. We saw yields back up a little bit this week. The 10-year bond, as we sit here on a Friday, is almost it's around 4.25. 5-year bond at 4.40, and the 2-year bond about a 5. And all of that's about 10 basis points higher than last week. But it was a grind, right? And you're still at levels below where you were a week and a half ago when the market was really fading a little bit. So you're just kind of in that summer doldrum, still shortened week because of the holiday mode. What drove yields higher? Probably a little bit of different things. Things like jobless claims, right? Which if you get a high number of jobless claims, in theory, that drives bond yields down a little bit. Well, those jobless claims came in lower than expected. You had the ISM purchasing managers for services come in a little higher than expected. On the other hand, durable goods were down and as expected. So, it was a push one way, a pull another way, et cetera. But next week is the real test, because next week you're going to get the CPI number and the PPI number, and we know those are crucial for not so much that the Fed's going to start cutting, but really to paint the picture of when the Fed's going to just stop raising. And we don't know what that's going to look like. We do know that this month, which will be the July numbers or August numbers for inflation, will be replacing August numbers from a year ago. That'll end up with a net, probably higher year-over-year number. It's the idea that gets kind of self-contained, and that the month-over-month annualized numbers and the 6-month annualized numbers continue to look okay.
Yeah. So the market is doing what the market is supposed to do.
Right.
And that is take in information, parse information, trade a little higher on that information, react and trade lower, try to find levels where there's some value. And in terms of what we have on the equity side, we do have some dry powder that we'll be looking to put to work over the next couple of weeks.
And I would say it's the same on bond side. You think about longer muni bonds, you're talking about maybe a 4.15 one week, 4.25 another week, 4.30. You're in that grind area. The difference is that that's real yield, and particularly when you do it on a taxable equivalent. Taxable bond yields are out there, 100 basis points over Treasuries, so people are getting 5% on bonds. The idea is, of course, is that you are paid for putting money to work, even incrementally.
Right. Good info, John. Everybody enjoy the weekend. Happy football season.
Yes.
See you next week.